Joining us to talk more about rates and the new regime at the Fed, Kelsey Berro is a fixed income portfolio manager at JPMorgan Asset Management. Kelsey, it's great to have you here. You said he was sprinkling a lot of Easter eggs throughout, so we'll come back to that. But what was your main takeaway from the thrust of what you think monetary policy is doing after the decision and the press conference?
Well, probably the best way to think about the main takeaway is just to look at the reaction in the bond market. So what you saw was a significant move higher in the front end of the yield curve. And that was even with the market already pricing one rate hike by the end of the year. So there was a further push higher in yields. But I think the more interesting thing was actually the long end of the yield curve. The 30-year yield actually moved lower. Now, what does that mean? I think that means that the market is saying, from an inflation fighting and credibility perspective, the Fed has that credibility. Inflation expectations have been coming down. 5-year inflation expectations are actually below where they were when the war started. And ultimately, that actually is a good thing for bonds. No one in the bond market wants to talk about rate hikes, but worse than a situation of rate hikes is a situation like you had in 2022, where the Fed didn't just hike a few times, but it had to hike a lot because they were behind the curve and they lost control of inflation. What the market is saying is we're not losing control of inflation right now.
That's not an uncommon thing to happen at all in the past. And the Fed eases many times the long end goes up because people say they should not be easing, and this is not what you're supposed to be doing here. You're here for price stability, and what you're doing is trying, for whatever reason, people that at the time think it's a bad move to cover. A lot of times they'll point to the long. Look what happened to the long end. The long end goes up. So I mean, sometimes I think that's even what's to be expected. Very rarely can the Fed control the long end by moving the short end, either up or down, right? I mean, it sounded like it was strange that you saw that when we've seen that again and again and again and again, right?
That is true. It's not necessarily unusual to see the curve flattening. So the yields moving higher in the front end than the long end when the Fed is taking a more hawkish approach. But I do think what is important is heading into this meeting, there were questions around what would Warsh's focus be? Would it be the agenda of the president to lower interest rates, or would it be the agenda of Congress, which set by Congress, which is price stability? And he was very clear that his focus above all else is price stability. And the reaction that you saw in markets was reflective of that focus on price stability.
For anyone that knows anything about Warsh, I don't even know if he is in favor of the dual mandate. He's always been all about price stability, and the guys he works for, and he's been with Druckenmiller for how long? I mean, there are a lot of people that think, go back all the way to Milton Friedman or whomever, that's the only role of a central bank is price stability.
One of the interesting things that he threw in, so Kelly mentioned kind of the Easter eggs. In the press conference, he avoided forward guidance. He didn't submit a dot in the dot plot. That was revealed, right?
Oh my God.
He said, I'm not going to
submit a
do
dot.
that.
It's a missing dot.
I love dots.
A missing dot.
I like the cherry ones.
Everyone else submitted a dot. He didn't submit a dot. So actually, it's interesting because he is the tiebreaker right now. You have 9 members who want hikes, 9 members who want to hold or cut, and then the final member would be Warsh. But in the actual press conference, while he didn't say what his view was, he did give us some really interesting Easter eggs. And I think one of the Easter eggs that you're referring to is this idea of accrual trade-off, is the way that he described it. So he not believing that there has to be this trade-off between tackling inflation and causing the labor market to weaken. And ultimately, the Fed wants to get to an equilibrium where prices are lower, the labor market stays stable, growth continues to rise. But the question is, how do we get there, right? What is the intermediate steps between where the economy is now, where inflation is clearly too hot, and getting back to that equilibrium? I think there's kind of 2 paths for the next 6 months. One is some of the work is done for the Fed. It could be that May was the peak in inflation. We just saw there's been an agreement. Oil prices are coming down. We've generally seen that inflation has been fairly well contained to gasoline and jet fuel, and is not necessarily spreading out to the broader basket. So maybe May is the peak in inflation. It starts to come down. You look at the jobs market. The last 3 months, 188,000 jobs created was the average. That's really hot. If that starts to come down a little bit, moderate a little bit, which I think makes sense given the broader context of the labor market, then maybe they don't have to hike to get to that ultimate goal. But there's clearly, two sides to the committee that are still divided here.
You want to put a straddle? Let me think if it's a straddle or a combination. One is the same strike price. The other one is different strike price.
Does that work for fixed income?
No, probably not. You could do it with bonds, I guess. Yeah, you could do it. You could figure out some synthetic derivative where you could, where you could, fade both the idea of a hike and the idea of a cut. And
just in the middle.
Wouldn't you do that right now and say it's more likely that we stand pat than go up or down?
No, exactly. And actually, that means that you should invest in fixed income for the income, for the carry, not because you're expecting yields to rise or yields to fall, but actually because we're in a great range right now.
Yeah.
When I talk to our investment grade credit team, they're saying, actually, we're really happy with yields in this range around 5 to 6%, because this is where we see all the demand. If yields were to really start moving lower, you wouldn't necessarily see that. But we're in a sweet spot where you have companies that are issuing a lot of debt to fund the next, big innovation, the data centers. And there are a lot of people out there that are looking at these yield levels and say, yeah, I want to participate at this point. So we actually think we're in a pretty sweet spot for yields. And you don't need to be expecting lower rates or higher rates to just want to have some income in your portfolio.
You're not a fixed income guy.
I'm not, but I remember decades of incredible economic growth and stock market performance when we were well above 5%.
Right. It wasn't a headwind.
It was not. Businesses didn't say, oh, my God, it's 7%. And when it was coming down from 7 and 8 to 6, we never thought it would get below 6, ever. So, we've been in this. I don't know what historically is the right level, where I don't know which was an aberration. But you look at, the 80s. And in fact, I was just going to quickly look at what was it during the dot-com bubble.
I know what it was. The 10-year. Well, let's let Kelsey answer the question. Yeah. But Kelsey, am I correct that we were over 6s, if not heading to the high 6s, as this was accelerating in like 99?
.com.
Right. And during that time, you had incredible levels of business investment. And we may be heading back to levels like that. We need to see. Right now, I would say business investment in the U.S. is still fairly concentrated. You're not seeing a lot of business investment necessarily outside of tech. But really, the question that you're getting at is policy restrictive? Yeah. And Warsh was asked that actually multiple times in the press conference, and he said it's uneven, right? There are some parts of the economy like housing where, yes, clearly we're restrictive. But if you look at financial markets, hard to say we're restrictive right now.
And look how long we've been sort of feeling bad for seniors and others that have had no way to, other risk-averse people, seniors and people like Kelly.
I'm not. No.
Did you know I was headed there? That really need a high, a risk-free interest rate where, where you can actually have a return.
No, listen, I've been so burned. January 2000, we were at, I don't know if we can show like a 25 or 30-year chart.
Do you like that elderly and seniors and Kelly?
By the way, we were at 474 in 1998 on the 10-year. November of 98, we were at 4.5.
Go back further. Go back to
the
early. Go back to like 93.
93, we were in the 6. So we were up at 8 in 91.
91.
Came all the way down to 5 under 6 by the end of 93.
Things are okay.
Yeah, things were fine. And then look, we were in the 7s in 94. We were in the 6s in 95, 96. We were in the 4s in 98. There's the long run chart. Yeah.
Right. I guess inflation was probably higher, too, so it made sense. So the real rates were probably similar.
Yeah, exactly. Real rates actually right now are quite high relative to history and more in line with those periods that you were just discussing.